Thato, thank you so much for your time. Let's check in on that JSE, especially looking at the Asian side, closing lower because of that, inflation expectations as we look ahead to the US. How are we holding up right now?
Good afternoon, Anastasia. Our market is down 1% so far today, in line with global markets, which are down between 50 basis points and 1% over the day. DM slightly lower than EM, and of course, the US inflation prints, probably the most important macro data point for the week, will guide us for the rest of the week in terms of the trajectory as far as the debate on inflation versus potential recession. And at the moment, inflation seems to be top of mind. You did mention, obviously, Chinese CPI at 2.7% and PPI at 0.8% year on year. Obviously very muted. There's no chance of rate hiking in the Chinese economy other than pork prices up over 20%. Is a sign of weak economic data at the moment and trajectory in the Chinese market. And Asia has been weak, as you pointed out, and fears of continued reversal and strengthening in the dollar and weakening of Asian currencies and EM currencies in general, with potential rate hike schedules for September and November, potentially 75 basis points in both of those upcoming Fed meetings. So a lot of concerns at the moment. The market is pricing in a 75 basis point hike if we look at the Fed funds rate futures, and perhaps consensus is being a bit too optimistic with the 8.7% CPI print which they're expecting.
Yeah. So a little bit earlier, we had Mike Davis, CFO at Nedbank, talking about the company's interim figures. Were there any key highlights for you when you look at the bank's performance?
The bank has performed well. Year-to-date retail deposit growth of 3.6% has been ahead of its peers within the Big Four. So advances growth has been quite particularly impressive in that regard. On the corporate side, not so much. Overall, we saw strong net interest income growth, I think about 7%, coupled with very strong performance on non-interest revenues of 13%, and part of that had to do with fees and commissions, obviously due to quite volatile markets during the period. ROE, I believe, around 13.5%, still below their medium-term target of 15 and longer-term target of 18%, but they do have levers to pull to improve that. At the moment, their CET1 ratio is still quite high, over 13%. They want that to come down to 11 to 12%. So, of course, there is capital which they could redeploy via increased dividends. For the period, dividends were up about 80%. They could also obviously reallocate that to further advances growth. So they do have levers to pull to improve on the ROE, as well as net interest margins through further cost controls. But so far, a quite strong performance from the top line in terms of retail advances growth, as well as potential further cost improvements and net interest margin improvements. Obviously, they mentioned that there are some headwinds in the local economy due to electricity and some other factors which will be of concern looking in the second half of the year.
Over the next few weeks, we're going to see quite a lot of the JSE-listed companies reporting their earnings. Is there anything in particular that you're going to be keeping an eye out for, especially with, I suppose, call it outlook or certain line items in those financial statements as those different companies report? What will you be focusing on?
Given the current environment where inflation is a significant concern, I think especially for Q3 this year, one will have a look at how various sectors and companies are able or unable to pass through inflation. So top line in terms of growth year over year in constant terms, is one of the, I suppose, measures as in terms of relative to inflation that market participants will be looking at, as well as GP margins, just to see how much pressure from a cost perspective and supply chain perspective the relative sectors are facing at the moment. And then various other sector-specific measures, just to get a sense of how well these companies and sectors are trading in the current environment. So certain sectors which may or the market may assume are better able to protect their earnings against inflation, such as consumer staples, utilities, telecoms, will be expected to do so. Other companies and sectors where one would expect trading down, so for instance in the retail space, certain companies that target lower income consumers may benefit at the expense of those focused more on the mid to higher end. So there's various factors and points of consideration that market participants will be looking for in the next or upcoming results season.
I'm just curious, how fragile or vulnerable is this market to data that might entail more than disappointing inflation figures or even higher interest rates?
I would say significantly fragile at the moment. If we consider one discussion around the US economy, whether or not it's in recession, every data point or new data point that comes in adds credence either for or against that argument. And we'll only know, I suppose, ex post or after the fact in 3 to 6 months' time. But at the moment, all data points are helping to build or perhaps destroy certain investment views or cases. Point in case, we had data on US oil inventories build-up that came out, where last week 2.2 million barrels of oil were added to strategic stockpiles, whereas consensus was expecting only 100,000 barrels. So that's a significant divergence, and that led to oil prices declining now at about $95 per barrel. And especially on the inflation front, because of course we know that the US economy, at least from a jobs perspective, with the numbers that came out last week Friday, is looking quite positive. Unemployment declining down to 3.5%, and this gives the Fed room to push through further rate hikes without the risk of causing a recession. And so the question, of course, is: are we going to see 2 additional 75 basis points hikes in the next 2 meetings, or will that moderate to 50 basis points hikes, or perhaps even increase to 100 basis points hike in the first meeting? And the print that will be coming out later today on US CPI will go a large way to determining that outcome. So I think the market is very fragile as far as certain macroeconomic data that is coming out, and it will frame many other aspects as far as yield curves, interest rates, as well as capital market prices on the bond and equity side over the next few weeks.
Thato, thank you so much for your time. That is Thato Mashigo, who's a portfolio manager at Sanlam Private Wealth, giving us his perspective on the markets and also throwing forward to what we can expect for that 2:30 p.m. CPI figure from